Good morning and welcome to the Shenkman Wealth Management Accountant Attorney Spring Webinar Series. This program is entitled Private Foundations, the 5 Deadly Sins or Excise Taxes. For those who don't know me, my name is Jonathan Shenkman. I'm the president of Shenkman Wealth Management. In that role, I work as a financial advisor, portfolio manager, and serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my program is to bring in professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 25 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, Bloomberg, CNBC, Fortune, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. You can also see my work on my website at shenkmanwealth.com/articles or by following me on social media at Shenkman on Money. Additionally, I just started my new podcast, which is also called Shenkman on Money, and you can check that out on Apple Podcasts, Spotify, or wherever you get your podcasts. One more quick note before I introduce our esteemed speaker, and that is the handout to this program was sent out within the reminder email this morning. It will also be sent out again in the follow-up email tomorrow morning as well. Today, we're privileged to hear from Andrew Katzenberg, partner at Aaron Fox Schiff, where he splits his time between New York City and Washington, D.C. Andy focuses on wealth transfer planning and preservation, multi-generational planning, estate and trust administration, nonprofit and tax-exempt organizations, and charitable giving. Among his high net worth clients are hedge funds and private equity managers, business owners, art dealers, and athletes. He also represents clients in forming and managing nonprofit and tax-exempt organizations, including public charities, private foundations, and private operating foundations, and acquiring and retaining their tax-exempt status. Andy has authored numerous articles related to his field and is a frequent contributor to the New York State Bar Association's Trust and Estates Law Section newsletter and a nationally recognized lecturer. In addition to his regular practice, Andy actively engages in pro bono work and is engaged regularly for his contribution and recognized for his contribution by the New York Legal Assistance Group and the New York City Family Court Volunteer Attorney Program. Andy also serves as an adjunct professor at the University of Baltimore Law School Graduate Master's Program. Today, Andy will be speaking on private foundations, the 5 deadly sins or excise taxes. And with that introduction, I'll now turn the program over to Andy.
Thank you, Jonathan. I appreciate you having me here today, and I appreciate everyone joining me this morning to hear my presentation. So again, what we're talking about is the excise taxes for private foundations. But before we begin there, what we need to clarify is, what is a private foundation? And so a private foundation is a tax-exempt organization, and there are several that usually one thinks about when someone uses that term. There's public charities, there's supporting organizations, there's private operating foundations, there's donor-advised funds, and then there's private foundations. Now, the excise taxes we're talking about today, they are special and unique that they only apply to private foundations and more or less private operating foundations. They do not apply to public charities or supporting organizations which are underneath public charities or donor-advised funds which are underneath public charities, because those are essentially self-regulated in their own right because they have outside pressures coming in, essentially donors, multiple, which again gives oversight. The concern with a private foundation is that it is usually contributed to by a single donor or a select few donors of a family, usually, and they're in control of the money. And the fear is there's no one to oversee it. They actually use it maybe for good, or maybe they do something wrong with it. And these excise taxes are designed to encourage good behavior. And if you don't follow them, then it slaps you with a very hard penalty to get you back on track. So again, that was their purpose when they were created. I think it was like the 1969 Act. That's when they got put in place. That's what they wanted to rein in at the time. And again, going back to the difference of, well, how do I know if these actually apply? Again, that's the first question. Do these actually apply to me at all? Am I a private foundation? Well, the default rule is that all tax-exempt organizations, when they are created under Section 509, they are private foundations unless you fall into an exception. So you default start as a private foundation with these rules applying. If you fall into the exception, you are a public charity, essentially, or a supporting organization, meaning that you are getting support from more than 1/3 of your support is from the general public or from the government. Those are things that pull you out of the private foundation realm and pull you away from these excise taxes. And again, private operating foundations are private foundations. They're just a little different, and one or two of the rules don't apply to them, but generally they do. So with that, we will move on to the actual excise taxes. Now, there are actually 8 excise taxes, but we're really only talking about 5, which I would say are more unique to the private foundation realm. And I'll just point out the ones that are not. So actually going in reverse order here, we have the unrelated business taxable income, UBTI. This is, again, if you are dealing with, you're owning some type of entity that's producing income that has nothing to do with your charitable cause. They tax you as essentially a normal for-profit, because why should, that making money for your nonprofit to spend somewhere else isn't a charitable cause in its own right. So you get normally taxed. This applies to all the tax exempt orgs. Then you have executive compensation. This excise tax only applies if you have someone being paid over $1 million of salary. And again, in the private, though it applies to private foundations, the reality is, in a private foundation context, it really doesn't come up. It really shouldn't come up, because I'd be hard pressed to find a private foundation that could justify paying someone $1 million in any capacity to run it, or any other to be a director of some kind in it. It just wouldn't fly, and I'd be less worried about the executive comp issue than some other one, maybe a self-dealing or overpayment, unnecessary expenditure. So that leaves us with the other, actually 6 here, but again, the last one is the investment income tax, which we'll get to in a second. I really wouldn't call that. That's not quite the same as the other 5, which is really self-dealing, the 5% minimum distribution rule, excess business holdings, jeopardy, investments, and taxable expenditures. Those are really the 5. But just to talk quickly on the net investment income, again, this is applying to private foundations. This essentially, I wouldn't really call it the same way as an excise tax as the others, which are punishments. This is just, it is what it is, that tax-exempt organizations do not pay any income tax when they generate income. However, this small amount of 1.39%, which used to be a 1 or 2% figure about 5 years ago, before the Trump Tax Act, this was changed and amended to 1.39% flat on any net investment income. I really wouldn't call it kind of an excise tax, rather just it's a regular tax that they pay rather than paying any of the income tax that others pay at a corporate rate of 21%. A net investment income is typically gross income reduced by certain expenses, capital gains. That amount you pay a small little tax. So nothing to really quibble about, but again, I wanted to mention it offhand. That's what brings us really again to those 5 excise taxes. And again, different from the other one that, a net investment income tax, that's just a tax, not really a punishment. These rules are designed to punish bad actors, I'll call it, or on the unwary who stumble into them, and to prevent them, from being very careful and mindful to talk to their advisors on what they're doing and why they're doing it before they do it, so we can advise them to avoid these. So the first one, I actually am going to use self-dealing as the last one, because I want to save the most time for that. So we're actually going to skip ahead, because I think that's honestly the most important one that you see people stumble over. And we're going to start with the 5% minimum distribution. So the minimum distribution is, unlike a public charity, again, that has kind of oversight from a board that is diverse and is there to give away and do some sort of cause, with donors all across the globe or all across the country or all across the city, that if they see you're not spending the money right, are going to stop giving you the money, and it's going to dry up. And/or will reach out personally to the Attorney General of your state, who usually is oversight for tax-exempt organizations, to encourage you to actually give away money. If you're a private foundation, you are private. There is no one there to really oversee you but yourself. And if you do the most basic, which is you have a matriarch or patriarch who creates a foundation, they plop in $1 million or 10 million or $100 million into it, there's no one to tell them that they have to give it away or to say, hey, why haven't you done this? There's the AG technically is there as well, but admittedly their oversight is minimal, and there's no one that's going to usually whistleblow on these folks because, again, it's really just them. So the rules are designed to make sure they actually give money away. This is one of the issues that people, just to throw out, that talk about donor advised funds, which don't have this rule. And are they really giving all the money quick enough to charities, or is it just sitting at this foundation and you use in order as a pass through for a tax, to get a tax deduction while you think about it? So what you must give away is 5% of essentially the total fair market value, is how you should look at it, of the foundation. However, that number is starts at 5% and is reduced by various items. So it almost is impossible for it to ever really be 5% of your fair market value. For example, you're allowed to have cash on hand of approximately 1.5% of your fair market value. That is not included. It's viewed as operating money. So that reduces what the fair market value is. So again, it's not 5% of the whole from there. You also have things like normal operating expenses, which are reduce the fair market value, which actually count towards the minimum distribution. So money spent on operating, like salaries, if you will get to the salary issue, but if you do have employees that you are paying salaries to, that actually qualifies as part of the 5% distribution. So again, the amount going out towards charitable causes is slowly going to be less than 5% of what your actual fair market value is. So that's the first thing. And again, it's not an unreasonable position because you view it from, get Jonathan on the horn and you get him investing your money. You're going to hope he's able, if he can beat 5% or equal 5% return on the growth, then you're going to be just eating into your income and you can reserve your endowment, the principal, and the foundation essentially should be perpetual from that position. Again, the other part, this rule does not, this is the one rule that doesn't apply to private operating foundations. The reason is an operating foundation essentially is, to qualify for one, is using 80% of its assets, has to meet several tests, one of which is 80% of its assets are being used towards charitable causes. So it's already giving away, it's actually using so much of its funds into the charitable context. There is no need to actually require to give more away. It's already giving more away or using more away for charitable causes anyway. So that's the logic why it doesn't have to apply. The other important factor with this 5% minimum distribution is that if you give more in 1 year, there's a carryover for 5 years. So if in 1 year, again, if it's, we're not really worried about this, worry about this really for bad actors, but if you're just in the normal course, you're talking to the charities you give to and you plot out, we give 100,000 a year, that gets us the 5%, great, and we give to these 10 charities or 2 charities, whatever it is you're giving to. But then in 1 year comes up and you say, hey, my university is doing, a capital raise to build, a dormitory. And I want to give more. I want to be the lead donor on this. And instead of giving 100,000 this year, I'm going to give $1 million to this. And so now you've given, obviously, instead of the 100, which was what you needed to give for 5%, you gave 10 times that. That $100 million, that $1 million, the first 100 would qualify for the current year. The balance, the 900,000, rolls over to the next 5 years. So if you choose to not give anything away, you still would have met the 5% test. So the next 5 years, again, if it's only 100,000, you'd use up another 500,000 would qualify for the minimum distribution. At end of year 5, with the 400 that was remaining, it would just disappear off your 990 PF, and you'd have to start over at 0, where come essentially year 6, you have to give away another 100,000. Again, when talking to your tax professional, you should consider, does it make sense? I want to give, $1 million to my alma mater. I'll give mine, Tufts University. I want to give $1 million to Tufts University to name, the Andy Katzenberg, dining hall. And I realized, hey, maybe instead of giving them $1 million this year, I give them 300,000. And I tell them, pledge to them, I'm going to give you $1 million, but I'm going to draw it out over several years, talking to the development office saying, well, when do you need these payments by? And they may say, well, it's going to take 3 years. So, obviously they want it all up front, but they also will be more than happy to say, well, if you want to do a 300, 300, 300, we're fine with that. And by spreading it out, it rolls the clock on each of those 300 blocks to one more year out. So again, by breaking that up, what I have been able to do, and again, let's say 100,000 is what I need. By breaking it up, the first 600,000 would entirely get used up, and then the last bit, I would end up getting another 100,000 on my last one, and only end up wasting 200,000 of that minimum distribution again. So that in the future, if there was a point where you didn't want to spend 100,000 in a given year for whatever reason, because you were saving it up, because you couldn't make a decision in that year, you don't have to. So again, that's something that, again, why you want to speak with your tax professionals to make sure you don't just say, oh, here, I want to give and I give in the smartest way is always the best way. So then we have next, excess business holdings. So excess business holdings is designed to prevent, and I should mention one last thing I didn't, and I'll mention these others. The tax on the distribution, if you don't do this, is 30% on the undistributed amount that you were supposed to give away. And if you don't give it away and essentially get caught, meaning the IRS sends you a deficiency notice, it can move up to 100% of that amount. And obviously, that's the point, that these penalties are very, very high, which goes to excess business holdings example. It's a 10% tax. Well, that's not that bad. You get a client who's like, I can handle 10%. That's not too bad. It was worth it. It's 10% each year. So in the first year that you had held excess business holdings, it's a 10% on that number. And then the next year is another 10%. Oh, and by the way, it can move up to 200%, which obviously is some more than the whole, which is problematic for everyone. And what is excess business holdings? It is the idea that you, as a private foundation, a tax-exempt organization doing nonprofit work, are not supposed to be owning and operating a private, a for-profit company. So if you have more than 20% of the voting stock in the aggregate with disqualified persons, which we'll talk a little more about again for a moment, think of it as the donor, the primary donor in this, but there's more people, and we'll get there when we get to self-dealing. If you and the primary donor have more than 20% of the voting stock of a business, it could be a corporation, it can be an LLC, it doesn't matter, then that is excess business holdings. You're essentially owning a for-profit, and we're not going to let you essentially do for-profit work and shield the income in a private foundation. That's what it's designed to get against. You should be not running businesses. However, there is an exception there that moves up that 20% to 35%. And this is if you don't have 35% of the voting stock and somebody else has effective control. Someone else is actually running the company, and your 35% does not. So if you have another owner who actually, this make it very simple, 65% of the stock, and you have 35 with your foundation and the main donor, and that other person is not anyway connected to the donor or the foundation, they have effective control because they have the majority vote. It would be up to 35% you could hold without this coming into play. Now, again, there is a whole bunch of exceptions when it comes to this, whether it's passive, whether you have a de minimis amount of stock, at the end of the day, that the foundation itself has a de minimis amount of stock. If you receive the gift, you receive by gift rather than purchasing a business, you didn't have a choice, that you were handed, 50% in an active business. You didn't make that choice. Why should I be penalized for what someone gave me? They give you an exception there that you have 5 years from the date you received it to essentially get rid of it. You can request an additional 5 years from the IRS, not guaranteed, but most likely you would receive it. So you can up to a 10-year runway to extricate yourself from this asset, because they don't want you to have to sell on a fire sale, because if I know you have to give it away or be subject to a 200% tax, you certainly will sell me that company at 50 cents on the dollar. But again, this issue comes up when, again, someone dies and leaves as a bequest to somebody, or wants to gift the foundation. or give their business to the foundation because they don't have really heirs, they want it involved in some way. Now, one of the new exceptions that came up that I think is worth letting people know about, which was supposed to be in the 2017 Tax Act. It didn't make it because of the Budget Reconciliation Act, the whole issue with the Senate and the Congress and the Senate, both them coming together, and there's a $1.5 billion or trillion billion, it's 1.5 billion that the difference in what they proposed when it comes to the cost. This would have increased it, so they had to pull it out. But then it found its way into the Budget Act of 2018, and this is known as the Newman's Own exception. This exception has a whole bunch of pieces to it of requirements. It was really designed for one. That's if you go get your salad dressing at the grocery store, your Fig Newtons with Newman, Newman's Own and his Mr. Paul Newman's face on it. He left his entire business to his charity, and basically they've been lobbying. This was about now in 2018. That was 9.5 years after he had died and given it to them. And so they were coming up on their 10-year clock, but they were going to have to get rid of this. And so they lobbied very hard for the last, several years to get this exception put in there that essentially is saying everything is going to charity. There's no way we can manipulate this. And they put these rules really for this one entity. The odds that you could fall into it are very unlikely unless you are so, again, you're very, very, very charitable and you don't want your family involved in one side of the business, then you might be able to get there. But again, that requires you really just almost moving the private foundation more into a public charity space than a private foundation space, though still being a private foundation. But again, something to be mindful of if you ever find yourself in that situation. Then we have Jeopardy investments. Now, Jeopardy investments, again, 10% tax on each Jeopardy investment applied each year. And if not corrected, it's a 25% tax if you don't do that. Again, these are, if you do this, you have to unwind it. That's the way to undo it. So it means you have to liquidate the asset, whatever it is, get out of that investment. This occurs basically, it's kind of a prudent standard test that, when you were investing in X asset, was it a prudent, reasonable investment based on the long-term and short-term financial needs of the foundation, based on all the facts and circumstances in the moment. There's no hindsight that if you went into 100% gold and the market crashes and look, gold does amazing, you actually made a ton of money, it's still a Jeopardy investment. Or the contrary is you go into investments and it tanked and it was a bad investment. That doesn't mean it was a Jeopardy investment. It's mean the investment did bad. So we don't go back in hindsight saying how well you did at the end of the day. It's in the moment. Did this make sense based on all of our needs? Or essentially, were you being risky? Okay, are you diversified? Is there a reason why you're spreading it out? You did a little bit in hedge funds, you did a little bit in gold, you did a little bit in the equities market, you did a little bit in bonds. And there's no one size fits all. But again, you want to make sure that you're on the straight and narrow with this. Again, there's exceptions for program-related investments, so you could be kind of concentrated because a program-related investment essentially is a charitable, investment idea. It's carved out in the code. And then secondly, if you were given a gift, again, the Jeopardy investment is about you taking a manager, making a decision, an active action that could put the foundation in jeopardy. If you were given something, a gift that, $10 million of a single stock, you haven't made any decisions. So you haven't made an actual Jeopardy. You haven't made an investment yourself. You've been handed a gift. So until you touch it and change something in it, and that could mean changing something in the terms of that agreement, it is not a Jeopardy investment, even if otherwise it would have been. So again, if someone's giving you something, if an owner wants to give you 100% of a company, well, not 100%, but a large portion of some company, you don't have to get out of that stock or that interest. Then there's also mission-related investments. This is noticed 2015-62. Again, this is there's only so many program-related program-related investments that are listed in the code. So it's kind of an open area of what else can qualify for outside of the program-related investments. This is mission-related. Essentially, when you invest, it doesn't have to be, the main goal doesn't have to be to return capital, your return. It can be return, and this does good. This will do some type of charitable return there, and it can qualify. So this gives you a little broader strokes on what you're investing in and pulls away on, why did you put so much in here? Because it's having some positive charitable purpose behind it. Then you have the taxable expenditures. Again, 20% tax per taxable expenditure, 100% if you don't correct it. Essentially, this is using charitable money on expense that is not charitable. If this is influencing legislation, influencing an election, again, you can't do stuff. These private foundations cannot touch political activity anyway, and this, is penalty here for it. You also could lose your entire exemption if you do that as well. Granting to individuals, you can't give to individuals unless it falls into an exception. You can't grant to other organizations unless it falls to an exception. And again, anything essentially, it's a non-tax exempt purpose is what's going on here. So that's that. And our last one we're going to hit, and I save for last because I want to make sure I give enough time to it, is self-dealing. Self-dealing is the most common one I think people really do fall under. 10% tax for each act applied each year can go up to 200%. Again, this is one to hammer you over the head if you really get over it. Self-dealing is any act, direct or indirect, between the foundation and disqualified person. It's irrelevant if it's in the best interest of the foundation. There's numerous exceptions, however. But again, we don't want to see disqualified people interacting using the money of the foundation in some way that ultimately benefits them when you've given it away to charity. It just seems too sticky. It seems like too much manipulation, and that's what this is designed to prevent. Now, there's two pieces to this. One, it's only self-dealing if you're dealing with a disqualified person. And as we mentioned, some of the other tests that refer to disqualified persons. So we need to make sure we understand the definitions there. And this is one that anytime you're trying to figure out, are you dealing with a disqualified person? You want to look at the rules. You want to look at section 49, 46, and then actually 267, which is the attribution rules. Everyone understands the basics that the main contributor, the grant that who gives, the $10 million to the foundation, they're a disqualified person. But there's a whole host of other people that also qualify for this. The fact whoever you put in as manager, which may be the same people, any family member connected, to that person, the spouse, ancestors, children, grandchildren, great-grandchildren. Again, all of them are disqualified. So your kids are disqualified. So any action with them. Then you have, estates and trusts are also going to be disqualified individuals if the people who are beneficial interest or in control of up to 35% of it fall into any of the categories above. And then same with if you have a corporation that's a contributor, the individuals that own greater than 20% of it, they're also disqualified individuals. So you could have your company give money to a private foundation, and your buddy who could have 20% of the company, he's a disqualified member too, even though it's your foundation. So again, you want to check these rules every time, making sure you're dealing with it. Then we get to, okay, self-dealing. Before I get to the necessary exception, self-dealing examples real quick. We have, if you loan money, let's go with the foundation needs money, and to go, and everything's a liquid. It owns a bunch of real estate for whatever reason, and it was gifted the real estate, let's say, and it cannot, needs money to actually do the charitable causes it wants, or meet the 5% minimum distribution test. Where is it going to get it? And you say, hey, how about I loan the money? It couldn't get it from a bank, and instead of loaning it 5%, which is, what the rates are going for these days, why not? I'll do it for 2%. I'm going to give it a deal better than it could get anywhere else. Is that self-dealing? Yes, that is direct self-dealing, because the disqualified person is benefiting by the 2% that it's getting foundation dollars back in its hand. Can't do it, even though it seems, even though it's best for the foundation. I own an office foundation, and I'm the disqualified party. Foundation asks me, hey, can I borrow, can I use some office space? And I say, sure. And you know what? I'm going to charge you half as much rent as I would anyone else in New York per square foot. So you're getting a great deal. Still self-dealing. The only way around those is you don't charge any type of fee, and essentially you're donating the money, lending it free, with no interest, or lending the office space free. Eventually you can get it back, but you're not getting anything. Again, nothing's coming back to that disqualified party. The last thing I want to mention, as I see time is almost run out, is that people run into with self-dealing is employing disqualified people as part of the foundation, where you have a son or daughter or yourself that you say, hey, I'm the director, or I'm running this. Shouldn't I get paid? I'd like my children to get paid, because maybe, you're concerned they're not going to get that great a job, or just, they're going to be doing good. Well, that's on itself, its face, that's self-dealing. They are all disqualified people being paid by the foundation, getting benefit money from the foundation. However, there's two exceptions there. And again, one is it has to be reasonable compensation, and it has to be for essentially a managerial job at the foundation. That's, you have to do it. Someone's going to have to do this probably and get paid. So reasonable comp part is that's a little easier. If you have a son who just got out of college and has no experience working on a foundation, has no experience in life, essentially, there's no reason why he should be getting $150,000 to run the foundation. I mean, even that would be excessive. He just doesn't have the experience. It wouldn't be reasonable based on his skill set. Plus, you have to figure out what someone in that position anyway would get paid, even if they were qualified. So that's issue one. Second is if it's a managerial role. So there's certain roles such as banking, investment advisor, and legal, which are in the regulations that are qualified for these kind of managerial roles. There's a few PLRs that kind of expand this. There's only a handful, so there's a little bit of a gray area once you get outside of those realms. The last couple in 2016 and 2019 essentially said management of real estate qualify. Another was doing the program, the grant making, the consulting also qualified essentially as managerial roles. That last one kind of opened it up a little more, where I think a little more comfort prior to that ruling than having someone in that role. And best practice really is telling your client, no, just volunteer your time, don't get paid. It simplifies the heck out of this, and we don't have to run into issues, because what's going to happen is over time, you get blessed what the client's doing. Client's going to over the years start increasing the salary. Oh, it's inflation adjustment, but they're not going to talk to you about it until they come to you 5 years later and you're talking about it, and they say, yeah, my son's getting paid $250,000 now. And you say, why? And you say, this looks like it's, self-dealing, and, you could be in trouble for this. And you have to unwind it. One, by taking the money back is the only way to correct it. And the money might not be there. And again, you can create a foundation. You can give your son money, or you can give your daughter money. That should be where you should be advising clients. And if they force it, find a way that fits in, but make sure they're following the rules. So I think that is my time. I've gone over a few minutes, but I appreciate everyone listening. If anyone, my contact information, I believe, is on the slide. I believe obviously Jonathan can provide it to you. And if you have any further questions, feel free to reach out. I'm always happy to chat on any issues. I love hearing good, interesting topics that come up from advisors out there. Just look at me as another resource.
Great. Thank you so much, Andy. If anyone has any specific questions, new business opportunities, or any other issues you'd like to discuss, please feel free to reach out directly to Andy or myself where appropriate. And again, I'll be sure to include Andy's contact information in a follow-up email to this program. As I mentioned at the onset, the goal of these programs is to stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. 3 more quick items before I let you go. First, my spring webinar series continues on Thursday, June 8th on 10 timeless investing principles and how they apply in today's market, featuring yours truly, Jonathan I. Shenkman. And I'll send out an invitation to this and all my upcoming webinars after the program. Second, if you have a friend, client, or colleague who would like to be kept abreast of my upcoming webinars, then they could sign up by sending me an email with the word webinar in the subject line. You can also follow my work on Twitter, YouTube, and Instagram at Shenkman on Money. And finally, as I mentioned before, you can listen to my new podcast called Shenkman on Money, which is available at Apple, Spotify, or wherever you get your podcasts. And finally, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provides timely and interesting content to attendees, and I thank you in advance for that. With that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.